everybody, this is Emily Duplessis with Rental Rookie. Welcome to today's video that's going to focus on another way for you to be able to finance or purchase real estate investments, specifically rental properties. Today's video is going to focus on conventional financing. My little tagline, the real estate investor's ticket to financing, is there because if you're planning on using bank financing for the purchase of real estate investments or rental properties, this most likely will be the type of loan product that you will use in that process. So let's talk a little bit about what is conventional financing. This is the most widely used financing for real estate investors. It's actually, a pretty well and widely used financing product for anyone that's out there buying a property, maybe not real estate investing, even just buying your own property. But for real estate investors, it definitely is the most widely used. Like I said, it can be used for personal and investment purchases. So if you're looking to buy your own personal home and going to be putting down a little bit higher of a down payment, conventional financing might be the avenue that you want to go. Most of these loans are purchased by Fannie and Freddie, so you know that they a lot of loans, what happens is, without, I guess, getting too in-depth, once you have a loan on a property, you close on a property, typically loans get sold in what is called the secondary market. And, you may get your loan through Bank of America and then get a letter 2 months later into your mortgage payment saying that Wells Fargo bought your loan, and now that's who's going to be servicing your loan. What happens with most conventional loans themselves are they are purchased by Fannie and Freddie, and that's who ends up backing and servicing your loan. However, they're not insured by anyone, and they may require mortgage insurance, and that all depends on your down payment. And if you've listened to the FHA one, private mortgage insurance is something that can be added to your monthly payment. There are some other avenues that you can go with getting it kind of rolled into your loan in the beginning, but depending on your down payment will determine whether or not you have to use any kind of mortgage insurance. What are typical terms for investing? For most single dwelling units, you must put 20% down. Okay, if you're looking at a duplex or multi-unit, maybe 2, 3 and 4 might be pushing it, because once you get into kind of 3 units, 4 units, you might be looking at more commercial loans. But if you're definitely buying anything like a duplex, it now requires 25% down on multi-unit properties. And that's actually a change that's just happened within the last couple of months. We actually recently bought a duplex. When we went under contract, we only had to put 20% down, but by the time we had locked in our rate for our loan, it had passed the date where they had made this switch, and so we ended up having to put 25% down on the duplex that we just bought. So that's definitely something that you're going to want to be thinking about when you run your numbers, paying attention to what type of property, whether it's a single or multi-unit. When you're putting down 20% for conventional financing, one great thing about it is that you avoid paying private mortgage insurance because of that higher down payment. So at the end of the day, with conventional financing, you're going to be putting more money up front, right? With a higher down payment, you're not putting 3%, 5%, so on and so forth, but it's going to actually make your monthly payment a little bit lower. And so sometimes it's maybe a bigger pill to swallow to put down more of that cash. But unfortunately, if you're going to use conventional financing and you're an investor, it's what you have to do. You don't really have much of an option. So let's take a look at an analysis here. You can see I kind of broke down, and this is just a quick analysis. I didn't go into too much detail, but this is what the numbers would look like on a property that you were going to buy for $80K. So if you look over to the left, you can see that the purchase price for the property is $80K, down payment 20%. You're looking at a down payment then of around $16,000, loan amount of $64,000. I put in the interest rate of 5%. Obviously, some of these things fluctuate depending on the market. Mortgage length, we're looking at 30 years, and you can see there's some information for closing costs, annual property tax, and annual insurance. And those are all pretty viable numbers. Property tax, depending on where you are, that's going to be your area. We have properties in one town where the property tax is $500 a year. Where we live currently, our property tax is over $2,500 a month or a year. And so, depending on where you invest, that's going to weigh in heavily on what type of property tax you're dealing with. If you look at the middle column, you'll see then it kind of breaks down to see what your monthly payment is going to be, principal and interest. We're looking at $344. Your property tax is about $100, property insurance $25 a month. If this is a single unit and you're planning on self-managing the property and your tenants are paying the utilities, and you are planning to do the outdoor maintenance, it's not in a condo, or HOA, then you're looking at a PITI of $469. If we look at the last box, you'll see that if that property rents for $850 a month, you are looking at a positive cash flow of about $381. That net yearly income is looking at just over $4,500, and again, you're looking at an ROI of around 24%, which is an extremely high ROI. It's a great one. Again, we didn't get into too much detail in this analysis of things like vacancy rate and CapEx and those sorts of things. Those things are topics that you can add into an analysis. You definitely want to account for them, but this was just kind of a quick and easy analysis so that you could see kind of what the conventional financing would look like on a deal with 20% down. As part of the Rental Rookie community, you can see all of the real numbers and financial breakdowns of our own rental portfolio. If you head on over to www.rentalrookie.com and head on over to the dashboard. If you're a member, you can just log in. If not, sign up for a free membership. And we have details, financial breakdowns, analyses on all of our rental portfolio there so that you can see and kind of learn through, what we've done and where we're finding success. So head on over there and check that out. The biggest thing, we've used conventional financing for all of our rental properties that we've bought, and it's been a great thing. How often can you get a lump sum of money for such a low interest rate over such a long period of time? So it really, really is a great avenue. The only, I would say, roadblock or drawback you have to it is really coming up with that larger down payment. But if you can get that, whether you save it, whether you pull in some partners or family members, if you're able to do that, then it really is a great option for you as a real estate investor. So like I said, head on over to the Rental Rookie website, join our Rental Rookie community if you haven't already. There's a lot of great free resources for you on there. And until next time, happy investing.